Look, everyone's running around saying commercial real estate is dead, office is finished, retail's been killed by Amazon, hotels got destroyed by Airbnb, and you know what? They're half right. But being half right in investing is the same as being completely wrong because you miss where the actual money is being made. Commercial real estate isn't dead. Bad commercial real estate is dead, and that distinction is worth about $100 billion if you know where to look. I've been doing this for 50 years. I've heard real estate is dead more times than I can count. I heard it in the 70s when inflation was running wild. I heard it in the early 90s during the savings and loan crisis. I heard it in 2008 when the entire financial system almost collapsed. And every single time, the people who said it was dead were the ones who got left behind when the cycle turned, because real estate is never dead. Demand for space doesn't disappear. People need places to live, work, shop, store things. What changes is which types of space are in demand and which are obsolete. And right now, while everyone's fixated on the carnage in office and retail, there's one sector that's absolutely booming. And I'm going to tell you exactly why. And more importantly, I'm going to tell you what almost nobody is seeing about where the next distortion is forming in this space. Let me start with what's actually happening in commercial real estate, because the narrative is lazy and wrong. Office isn't dead. Class C office and tertiary markets with 7-foot ceilings and no parking is dead. That was already dying before COVID. The pandemic just accelerated it, but Class A office in major cities with long-term credit tenants and modern amenities. That's trading at discounts that make no sense if you understand that high-value companies still want their people together. They want culture, they want collaboration. They're not going to run a $50 billion company over Zoom forever. So there's opportunity in office, but you have to be very selective. Retail's the same story. Malls in dying markets are finished, but grocery-anchored shopping centers in growing suburbs, logistics facilities that got reclassified as retail for some insane tax reason, those are doing fine. You can't Amazon your way out of needing a place to buy milk and pick up your prescription. So again, retail's not dead. Bad retail is dead. Hotels are actually interesting right now. Leisure travel has come back strong. Business travel is still weak, but it's recovering. The problem is the same problem that's plagued hotels forever, which is that they're operational businesses disguised as real estate. If you don't have a great operator, you're dead. But if you can buy a well-located hotel at a basis that makes sense and you have a competent operator, there's money to be made. The key is that nobody's building hotels right now because construction costs are insane and debt is expensive, so supply is constrained. But here's what everyone's missing while they're obsessed with these narratives. Industrial real estate, logistics, warehouses, distribution centers, cold storage, data centers. This is the sector that's booming. And it's booming for reasons that are structural, not cyclical. And I want to be very clear about what I mean by that, because this is the most important distinction in investing. Cyclical demand goes up and down with the economy. Structural demand is driven by fundamental changes in how the economy works. Cyclical investments can make you money. Structural investments can make you generational wealth. So why is industrial booming? E-commerce. It's that simple and that complicated. 20 years ago, if you wanted to buy something, you went to a store. The store had inventory in the back. The inventory came from a regional distribution center. That distribution center was probably 100,000 square feet and served a whole region, and that was the supply chain. Today, you click a button on your phone and you expect that thing to show up at your house in 2 days, sometimes same day. That requires a completely different supply chain. You need warehouses close to population centers. You need last mile distribution facilities. You need sorting centers. You need fulfillment centers. And all of that requires space, lots of space. The numbers are staggering. E-commerce is still only about 15% of total retail sales, but it requires about 3 times as much warehouse space per dollar of sales as traditional retail. Think about that. Traditional retail, you've got inventory in stores where people are shopping. E-commerce, you've got inventory in warehouses. Then you've got to ship it to people's houses, which means you need more warehouses closer to where people live. As e-commerce grows, and it's going to keep growing, the demand for industrial space grows exponentially. This isn't a trend. This is a structural shift in how commerce works. And here's the beautiful part. You can't just build a warehouse anywhere. You need to be near transportation infrastructure. You need to be near highways, rail, airports, ports. You need to be near labor. You need to be near population centers if you're doing last mile delivery. That creates barriers to entry. That creates scarcity. And scarcity plus growing demand equals pricing power. This is Econ 101, but most people are too busy chasing the next shiny object to pay attention. I started buying industrial real estate in the late 90s and early 2000s when nobody cared about it. It was boring. The rents were low. The tenants were unsexy. But I saw what was coming with globalization and supply chains. I saw that as manufacturing moved overseas, you needed more distribution infrastructure in the U.S. to handle imports. I saw that just-in-time inventory meant companies needed more warehouses, not fewer, because they were holding less inventory in each location, so they needed more locations. And I bought everything I could find at replacement cost or below. When e-commerce started taking off, that thesis went into overdrive. Amazon alone has something like 400 million square feet of warehouse space. Walmart's trying to compete, so they're building out their distribution network. Every retailer that wants to survive has to have an e-commerce strategy, which means they need warehouses. Third-party logistics companies are exploding because smaller retailers can't afford to build their own networks. All of that is demand, and it's not going away. Now let's talk about the returns, because this is what matters. Industrial real estate has been the best performing commercial real estate sector for the last decade, and it's not even close. Cap rates have compressed as institutional investors figured out what I figured out 20 years ago. But even with cap rate compression, you're still getting attractive yields relative to the risk, and you're getting rent growth that's been running 3, 4, 5% a year in supply-constrained markets. You're also getting long-term leases with contractual rent bumps and often triple net structures where the tenant pays all the operating expenses. That's about as close to a bond as you can get in real estate, except the bond keeps paying you more every year. And construction costs are your friend here. It's expensive as hell to build a warehouse right now. Land costs are up, materials are up, labor's up, entitlements take forever. That means new supply is constrained, which supports rents. And even when new supply comes online, it's getting absorbed quickly because demand is so strong. I'm seeing markets where vacancy rates are in the low single digits. That's tight. That gives landlords pricing power. Let me also talk about the tenant base, because this matters. In office, you're dealing with companies that might downsize or go remote or go bankrupt. In retail, you're dealing with retailers that might get Amazoned out of existence. In industrial, your tenants are the backbone of the economy. They're Amazon, FedEx, UPS, DHL, third-party logistics companies, manufacturers, distributors. These are businesses that have to exist for the economy to function. They're not going anywhere. And they sign long leases because moving a distribution operation is expensive and disruptive. So you've got stability, you've got credit quality, and you've got rent growth. That's a pretty good combination. Data centers are another piece of industrial that people don't think about enough. Every piece of software, every streaming service, every AI model, every cryptocurrency transaction, all of that requires servers. Servers require data centers. Data centers require massive amounts of space and power. The demand for data center capacity is growing faster than almost any other real estate category because of cloud computing and now AI. And you can't just build a data center anywhere. You need access to huge amounts of electricity. You need fiber optic connectivity. You need security. You need cooling. The barriers to entry are enormous. If you own well-located data center assets, you're effectively owning infrastructure that the digital economy can't function without. Cold storage is another subsector that's booming. People want fresh food delivered to their houses. That requires refrigerated warehouses. The amount of cold storage capacity in the U.S. has been growing, but it's not growing fast enough to keep up with demand. And cold storage is expensive to build and operate. You need specialized refrigeration systems. You need higher power capacity. You need higher ceiling heights for racking. All of that creates barriers to entry and supports rent premiums. If you can own cold storage assets in the right markets, you're in a very good spot. Now, here's what I want you to understand about industrial real estate that separates it from the other sectors. It's boring. It doesn't get headlines. Nobody's writing think pieces about the future of warehouses. There are no flashy amenities or architectural awards. It's just big boxes with concrete floors and roll-up doors. And that's exactly why it works, because boring means less competition from stupid money. Boring means people are making decisions based on fundamentals instead of narratives. Boring means cap rates don't get bid down to insane levels by people who don't understand what they're buying. I've always loved boring businesses and boring assets. They compound, they're predictable, they generate cash flow, and nobody's trying to disrupt them with some app or some new technology. You need a place to store stuff, you need a place to sort packages, you need a place to run servers. That's not changing, and that predictability is valuable. But I'm going to tell you something that's going to make you think. Even within industrial, there are massive differences in quality and return potential. Location matters enormously. A warehouse 30 miles outside a major city is worth way more than a warehouse in the middle of nowhere, even if the building is identical. Proximity to labor, proximity to customers, proximity to transportation infrastructure, all of that drives value. So when you're looking at industrial assets, you can't just buy anything with a roll-up door and call it a day. You need to understand the sub-market dynamics. You also need to understand the difference between single-tenant and multi-tenant. Single-tenant means one company leases the whole building. If they leave, you've got 100% vacancy. But you also typically get longer lease terms and lower operating costs because it's triple net. Multi-tenant means you've got multiple smaller tenants, more diversification, shorter leases, higher operating costs, but also potentially higher rents per square foot. Both can work. It depends on the risk you want to take and the return you need. I also want to talk about the capital flows into industrial, because this tells you something about where the smart money's going. Institutional investors, pension funds, sovereign wealth funds, they're all piling into industrial real estate. They're paying higher prices than they used to because they figured out that the risk-adjusted returns are better than almost anything else in commercial real estate. That's driving cap rate compression, which means if you bought 5 years ago, you've seen massive appreciation on top of the cash flow. If you're buying today, you're not getting the same deals, but you're still getting a good asset class with structural tailwinds. The other thing happening is build-to-suit development. Companies like Amazon are going to developers and saying, we need a 1 million square foot fulfillment center in this location, build it for us, and we'll sign a 15-year lease. And the developer builds it, leases it to Amazon, and then sells it to an institutional investor at a 4 or 5 cap. The investor gets a long-term lease with a credit tenant. Amazon gets exactly the building they need. The developer makes a profit and moves on to the next deal. Everybody wins. And that's creating a massive amount of new institutional quality industrial product. Now let's talk about the risk, because nothing's a sure thing. The biggest risk in industrial is oversupply. If everyone figures out that industrial is the place to be and they all start building at the same time, you can end up with too much space and rents flatten or fall. I'm watching this closely in certain markets where there's been a lot of speculative development. Phoenix, Dallas, Atlanta, some of the Inland Empire in Southern California. These markets have seen huge amounts of new construction. If demand doesn't keep up, you're going to see pain. but in supply-constrained markets like New Jersey, Southern California, closer to the ports, parts of the Midwest with good logistics infrastructure, I'm not worried about oversupply. The other risk is recession. If the economy goes into a serious recession and consumer spending falls off a cliff, e-commerce growth slows down, companies don't need as much warehouse space, that could hurt rent growth and occupancy. But here's the thing, even in a recession, people still buy stuff. They might buy less, but they're not going to stop buying. And the structural shift from brick and mortar to e-commerce doesn't stop in a recession. It might slow down, but it doesn't reverse. So I think industrial is more recession resistant than most other commercial real estate sectors. There's also technology risk. What if autonomous vehicles or drones or some other technology completely changes how logistics works and you don't need as many warehouses? Possible. But I'll believe it when I see it. The infrastructure required to move physical goods from point A to point B is not going away anytime soon. Even if delivery gets more efficient, you still need places to store inventory and sort packages. So I'm not losing sleep over technology risk. Let me also address something that's going to be critical going forward, which is sustainability and ESG. Institutional investors care about this now. They want buildings that are energy efficient. They want solar panels. They want EV charging stations. They want buildings that meet LEED certification or other green building standards. If you're developing new industrial product and you're not thinking about this, you're going to have a harder time leasing it and selling it. The good news is that newer industrial buildings are way more efficient than older ones. Better insulation, better lighting, better HVAC systems. So if you own modern industrial product, you're in good shape. If you own old, obsolete warehouses, you're going to have to invest in upgrades or you're going to lose tenants to newer buildings. Now, I promised you I'd tell you where I see the next major distortion forming, and here it is. Everyone's piling into coastal markets and major metros for industrial. New Jersey, Southern California, Seattle, Atlanta, Dallas. Those markets are getting expensive. Cap rates have compressed. Land costs are high. Competition is fierce. But almost nobody is looking at secondary and tertiary markets in the Sun Belt and the Mountain West that are seeing huge population growth and massive in-migration of both people and businesses. Markets like Boise, Salt Lake City, Reno, Tucson, Albuquerque, smaller cities in Texas and Florida and the Carolinas. These markets are growing fast. They need distribution infrastructure. And the pricing is way more attractive than the primary markets. If you can get ahead of that growth, if you can buy land or existing buildings in the path of progress before everyone else figures it out, you're going to make outsized returns. The risk is that you're early and the growth doesn't materialize as fast as you think. But if you're patient and you buy right, you're going to do extremely well. This is the same playbook I used in the 90s and 2000s when I was buying in markets that nobody cared about and then watching them become major logistics hubs. History doesn't repeat, but it rhymes. The other distortion I'm watching is the intersection of industrial and renewable energy. You're going to need massive amounts of battery storage and distribution infrastructure as the grid transitions to renewables. You're going to need warehouses to store solar panels and wind turbines and EV batteries. You're going to need manufacturing facilities to build this stuff domestically because everyone's worried about supply chains now. That's going to create demand for industrial space in markets that have cheap land, cheap power, and access to labor. If you can identify which markets are going to benefit from that shift, you're ahead of the curve. So here's what I want you to take away from this. Commercial real estate is not dead. Specific sectors within commercial real estate are struggling or dying because of structural changes in demand. But industrial is booming because of structural changes that are increasing demand. E-commerce, logistics, data centers, cold storage. These are not fads. These are fundamental shifts in how the economy operates. And if you can own assets that benefit from those shifts, especially if you can buy them at reasonable valuations in markets that are undersupplied or underappreciated, you're going to build serious wealth. Stop chasing headlines. Stop assuming that what worked in the past will work in the future. Start looking at where the actual demand is. Start asking which assets generate cash flow and have structural tailwinds. Start buying boring things that compound. And start paying attention to secondary markets where the pricing is better and the growth is real. If you want to think like an owner instead of a speculator, subscribe to this channel, hit the like button if this changed how you think about where the opportunity is in commercial real estate. And leave a comment with your investment thesis or your doubts. I'll try to answer honestly, even if the truth is uncomfortable, because that's the only way you get better at this game.